So all of you, please, we are sharing the case study of today's workshop. So please download from the WhatsApp group. Okay.
Online participants, we are about to start the event sharp at 11:05. We have shared the case studies for today's event. So kindly check that, and we are about to start.
Thank you.
Thank you.
All the participants requested, please occupy their seats. We are starting the program. All the participants are requested to please occupy the seats. It's 11 o'clock, please. Please. Please.
Yes, yes.
We'll start sharp at 11, please. Dipesh sir. We are starting the program, please.
Okay.
Sir.
Now come.
So before we start, we'll go to our last meeting. If you can, maybe point. Yeah. And then you will think so that you will put your permit. Our sees what is something. Yes, yeah, just great. You want to get the right. And then you will give your pay like this. Thank you. You're taking pictures. I'm ready to go again. I made a video. Now I'm going to take it down. This if you want to go again. Let's go. It is arrangement.
फिर हम उनको भी अपने भगवान के सामने झुको।
Okay, can we start? No, I'm. Please call everyone. Okay, so welcome back to our second day of foreign FDP, international FDP. So, first of all, warm welcome to all the participants who have joined in online mode. I hope you are able to hear me and I am clearly audible to all of you. Welcome to all the participants who have joined us in physical mode. Yesterday, we have discussed about certain things that will help us to value a particular company through a particular case study. And the most important thing is that how to make our class effective and engaging. That was the learning that most of us have taken yesterday. Today also, we will be discussing another case study, and this case study will definitely help us to get insight about finance. So all the online participants, I would request once again, if you have any query and you are very valuable to us. So if you have any query, please ask questions. Discussion, we all are faculty members. And as a faculty, if we are involved into discussion, a constructive discussion, then it will aid to our knowledge. It will aid to the value of this FDP also. So I request all the participants sitting over here and who have joined us online, please have a healthy discussion, ask questions, so that if anything is not clear to you, please, online participants can raise their hands and our volunteers will unmute you, or you can write your question in chat box. Those who are physically present here, if you are not getting anything, if there is something to be repeated, please don't hesitate. Please ask, because if you ask, then it's a golden opportunity and we'll be taking a great advantage of this opportunity. So please clear all your doubts if you require that yes, it is to be dealt in some another manner. Right? Thank you very much. Over to you, sir. Thank you.
Okay. Good morning, everyone. The secret of getting ahead is getting started. With this quote, I, Amisha Sethia, welcome you all on the second day of our faculty development program on corporate finance, research, and teaching pedagogy. So, without any further delay, I would like to invite Dr. Dennis Wing, sir. Over to you, sir.
Thank you. Good morning, everybody. I thought after yesterday we worked so hard. I would expect that maybe 5 to come. Maybe 6. But still, most of you are still here, so that's been that means that we actually have done something good yesterday, and I'm very happy with that. So today we're going to do real case studies because yesterday was, of course, an introduction into the more conceptual thinking of finance, like doing the financial analytics, having a look at valuation, a little bit into practice. We did it with Lego case, we looked at the Ben and Jerry case, but for the next 2 hours, actually for the next 4 hours, I'm going to break it down into 2 case studies. We're going to do the Ben and Jerry case. Maybe you think, well, we did that yesterday. We did. But now we move on from financial analysis to valuation. Yes? And at the second part of the day, after the lunch break, we're going to do Bang and Olufsen. Yes? So Bang and Olufsen case study. If we look at Ben and Jerry yesterday, we've clearly seen you've done all your analysis. So you've done your financial analytics, you've done your current ratios, your quick ratios, and you wrote down something on paper. Then we had a discussion on economic value added, and you have looked at the spreadsheet. And then I asked you again, so what would you add to your flip over? Just to start a little bit slower, before we go to do the valuation part, I would like you to discuss with your group members and just write it down on a piece of paper. What do you think you should manage? And not only from Ben and Jerry perspective, but also from Unilever perspective. So if Unilever is wanting to buy Ben and Jerry, you need to understand that you're buying yourself a company which has a negative economic profit. Yes? And Unilever wants to acquire Ben and Jerry to integrate the company into Unilever. Now, I would like you to just simply discuss on your table with your group mates. What would be in it for Unilever? Why did Unilever buy this company? And what would be, how can we identify what we call synergies? And if there are synergies, how are they related to what you wrote on the paper? Because remember that yesterday in the morning, I asked you, you have your KPIs, you have your financial analysis, but then what? What do you think the company should manage? Everybody has written down some of the points. So my suggestion is when you talk about synergies, relate to the things that you wrote down yesterday on a piece of paper. For example, you could see that SG&A should be something that should be managed, I think. I think some of you also wrote it down. So when you take a look at it from the perspective of Unilever, also discuss with your table to what extent can we create any synergies in the SG&A part of Ben and Jerry. So I'm actually looking for some creative ideas from your perspective. Okay, how can we create synergies? So in a nutshell, one step back, on the piece on the table, we're going to discuss the why Ben and Jerry would make sense for Unilever. That's one. And two, if you talk about pricing, synergies, are those synergies? So identify the synergies and also explain with your group mates how they can be realized. Yes? And then we're going to have a discussion on that. And then we're going to have a look at the case because the price of it. Yes? So per table, a piece of paper, and just write down what makes sense and also what would be the synergies you're looking at. Okay? Let's say 10 minutes or 5 minutes, 10 minutes, 11 minutes. Some of you are looking at the case, but you do not find it in the case. It's really like thinking about yourself about what you've seen yesterday. Two ice cream companies, we all know Unilever more or less. We know Ben and Jerry, which is a small ice cream company. Look at the P&L, for example. Look at what the expenses are. So my suggestion is also to go back to yesterday's spreadsheet. Let's have a look, what's in the P&L that can be measured, that can be more efficiently managed. And how can you do that? And if you're finished, we're going to turntable to have your view. So we're going to have a discussion on your ideas, create synergies per table. Just a few points to the paper. Few minutes left. Yes. Yes, we are right. Yes. Back to back, yes. Yes. Okay, very good. That's 3 minutes left. Everybody write down a few consider this. Synergies can be mobilized to data. It's actually well, let's say 5 minutes, then we go to the discussion per table, but also try to figure out what we're talking about. So this is mainstream business. So think about practical stuff, like how can you then realize these synergies if you're talking about distribution? How would that work? Yeah, let's say 3 minutes, and then we go to start again. Per table, 3 minutes. Okay, let's have a look at what you come up with. If in an M&A deal, merger and acquisition, you're looking at valuation, and you're basically looking at, how can we, as a Unilever, obviously you want to buy this company, but okay, then the question is to get the pricing. What kind of price are you going to pay for that? And part of the price is what can we do in terms of synergies? And synergies is like a fancy word for simply looking for items that you can normalize in your P&L, right? That's actually what we're looking at. Items that you can normalize in your P&Ls. How can I actually look at my P&L and what kind of items can I get out of them, which are basically not recurring again, like, which will not recur next year. So maybe I can do something about my sales, maybe I can do something about else. So otherwise you're looking at your P&L and you look at what items can I actually take out to increase my profitability. That's actually what synergy is all about. Let's have a look per table, and per table you can only mention 2 synergies. Can I start with your table? What kind of synergies you identified? Do we have a mic, maybe? Mike? Yes. Yeah. So what 2 synergies you identified?
The first one is we have observed that the cost of goods sold, which was around 71%.
Yeah.
In 1993 has reduced to around 61% in 1999.
Yeah.
Cost of goods sold has continuously been increasing.
Yes.
Second thing, definitely Unilever will be having sufficient number of resources so that we can reduce the selling and administrative expenses as well.
Yeah.
That would be a bigger part where we can save a lot of costs.
Yeah. Okay. If you look at cost of goods sold in terms of revenues, what is the percentage in the last year?
In 1999, it is 61%.
And the SG&A?
It is 30%.
Okay, just write it down. Okay, thank you. Obviously, most groups probably have the same, but let's wait and see if we have some other creative. Yes.
So in that case, what company Unilever is a big giant.
Yeah.
Then Unilever will take over this Ben and Jerry. Then Unilever will pay off all the debt that Ben and Jerry is having. So that the interest cost would be reduced.
Yeah.
And if the interest cost is reduced, net profit will increase.
Yes.
Which will lead to increase in economic profit also. Second thing is that Unilever has a wider distribution channel.
Yeah.
So when this Ben and Jerry, it's an ice cream company looking to the distribution channel of Unilever,
Yeah.
the selling and administrative expenditure will also decrease. Because in this particular case, cost of sale is declining. So that is not an issue. It means they have good inventory management,
Yep.
they have good purchasing, they have good relations with their suppliers. Only thing is that they have to reduce their selling and administrative expenditure.
Yeah.
And when they will, and how it will be happen?
Yeah.
If Unilever, because Unilever is having good distribution channel.
Yeah.
So it would be a synergy of distributing ice cream through the distribution channel of Unilever.
Yes.
So selling and administrative cost will reduce. Ultimately, both will increase their net profit and economic profit will increase.
Okay.
And it is also mentioned that the profit is increasing year by year. If you see the cost of capital, WACC and ROIC, if you say WACC and ROIC,
Okay.
then WACC is 10% and ROIC is increasing every year, year on year.
Okay, so in
That is
some,
okay.
yeah, okay, so in some you're saying that the synergies can go through your capital structure, right?
Yeah.
Which will have a
Capital structure.
yeah, positive impact on the cost of capital, but also on the logistics side, you're talking about working capital, and also think you're talking about SG&A, right?
Yeah,
Yes, okay. Okay, fair enough, thank you very much. Somebody else, yes. What did we forgot? Yes.
So only point is that the selling and administrative expenses will get reduced because of the sharing of resources.
Yes.
But on the other side, reducing the interest burden will only increase the weighted average cost of capital for the Unilever.
Yes. How would that work?
Sir, weighted average cost is basically if we the cost of debt is less than cost of equity, and if you are reducing the lower portion, then definitely the higher side will increase. So it will increase the weighted average cost for the Unilever only. So instead of reducing the debt further, yes, we should try to focus on reducing the operating cost.
Okay, so looking at the operating costs, makes sense, because you can actually decrease your SG&A. But could you explain again how the cost of capital would increase if you reduce debt? It's not so,
Suppose cost of debt is 10%, cost of equity is 12%. Now, proportion is 50-50. And if we try to reduce the debt portion, suppose we are reducing that to 0%.
yeah, okay. But I think, but could you comment, because what you're, yes?
Yeah. Actually, cost of equity depends upon the dividend base. And if company will earn more profit, and it was mentioned that major shareholding is with the owners, not with other shareholders. So if they will reduce the debt component, it will increase more value to the shareholder. And one more thing over here is that the Ben and Jerry return on equity, return on capital employed is increasing in a level. You will see WACC and ROIC. WACC and ROIC, you will see it is going, WACC is constant 10% from 1993 to 1999, and ROIC, if you will see, it is an increasing level. So by making a company a debt-free company, and it is also said that if a company is debt-free company, the valuation, the equity, the perception of equity would be higher. So the share price of that particular company will also increase because it's a debt company. The same thing happened with Reliance Industry. When Reliance Industry made themselves debt-free, the prices of Reliance went up. So that is also the reason for in my opinion.
Okay, yeah, last point, yes. I think you disagree, right?
Yes, sir.
You disagree, I think. Yeah, yeah, but say, please, yeah, please. Yes.
So increasing the cost of equity will not only increase the expectations of shareholders, and ultimately it will increase the cost of equity also. Because if you are paying more dividend, the cost of equity will increase.
Yeah, okay. Yes, okay.
Actually, it is a perception based, right? And what will happen? Okay, so what will happen? There is a perception. So when you are debt-free company, you increase dividend. So ultimately, there is increase in share prices also. So that will give more value to shareholders because shareholders get two types of value from equity investment. One is dividend and another is capital acquisition. So the whole value for shareholder will increase if the company will become debt-free. Second thing that I would like to mention over here is that if the company is debt-free, it depends upon what is the market situation. If the ice cream, like sir has also mentioned, that you have to see that company is ice cream making company. So when you are selling it in winter season, so the sales in winter season is low, the sales in summer season is high. So looking to that particular concept, if time horizon that is given over here is of a winter season, okay, then in that case capital structure can be diluted. But when the sales is high, then in summer season the sales of ice cream is high. So at that particular point of time, the date always should be at a lower level in that particular thing. And this company belong to which country, sir? US. And US, so that is more.
Yes.
To now take forward the discussion.
Yeah, very good.
Considering what we have been able to see that Nigeria has 37% US market share of ice cream.
Yes.
If we are talking about ice creams.
Yes.
So it's a very big market share among the three players.
Yes.
And also considering the case in court with respect to the strongest competitor that is having there, that they will have opportunity over it. So if we were able to add one new product line to their offering, which
Yes.
is acting as an added advantage. In terms of capacity building, I think it is acting in terms of synergy. So not only looking into the financial, but also looking into the strategic level, it is a decision to synergies.
But adding the product line also with that.
And it's not really like-
Yeah.
So they have a brand, right? They have strong branding.
Yes.
Easy for them to, even back Ben and Jerry
Yeah.
with their own brand, currently with their own brand, with Unilever's brand. So
Yes.
it's again, I think it's a win-win situation for both.
Yes. Okay, good. To comment on, yeah, yes, go ahead. Yes. You were part of the discussion, right? So try, yes. You were the second one. Yes. Yeah, yes. But not on the back yet. Not back.
Different, I would like to say, it depends on how Unilever is trying to fund this activity.
Yeah.
If they are funding this acquisition through cash or through equity, then it's okay. If they are taking a loan, then it may be proved to be troublesome.
Why is it?
Yeah.
See, why is it not a core business of Unilever? So in terms of technology, in terms of knowledge, they are, they will have an additional advantage if they go with management because that is what they are getting. Without, if they think of having this product line, they have to invest more. If they think of having a new setup, scratch, it will have cost them more. Having a brand of 37% market share,
Yeah.
and then going ahead, they are already only working on developing the market and making the brand stronger.
Yeah.
This is what I think. It doesn't matter that whether you're funding it from equity or from your debt, but it's adding an additional product line, additional.
Interesting. Okay. Yes. One more. You were the first one, right? You were right. You were, yes. Go back to you. Okay. Last point, huh?
Yeah.
Last point. Yes.
Yes, when I was going through the case study,
Yeah.
I was also mentioning sometime that the cost of capital for
Yes.
this Unilever is less.
Yes.
So that will also help them.
Okay. I understand. Okay, this I understand.
Yes.
Okay, to summarize, look, the discussion was interesting about cost of capital and debt, and I think you made a very nice comment. And that's also part of how I look at the M&A deals, most M&A deals. If you would like to create value, most of the times value creation does not go through the capital structure. I think that's also your point. Value creation goes through the P&L top line, yeah? And the rest will follow. It's the same, yeah? If you focus on the top line, the rest will follow. Yes. So focus on the sales, focus on your product market combinations. If you do a better job in that, the profitability will follow. Sometimes you get an argument like, yeah, we need to change the capital structure, and that way we need to create our the value. But yeah, it's not a hedge fund, it's not a private equity fund. It's very difficult to come up with the capital structure to create real value. Well, the real value on the table is the proposition and the top line, the strategic point of view. I think that's very with you all the way. But you also made a point because maybe, and this is a more theoretical point of view, Unilever. Okay, yeah, well,
They are not, like your voice is not clear.
that's not good. Just wait a minute. Yeah, oh, yes. Maybe a little. Oh, yes.
Okay. Yeah.
Yeah, okay. Yes. I think it works. Okay, so okay, Unilever is listed on an exchange, and because this is on an exchange, you have the cost of capital that's related to the exchange, and the cost of capital is related to the investors holding in the portfolio, which diversified. We're all finance professionals, so we're a little bit faster than the whole. But the theory of non-alignment actions is okay. If you have a diversified portfolio, you only have, the stock in the portfolio, and you can diversify away from specific risks. So what you have left is diversified return. Yes, the diversified return is very efficient. There's the risk return is high in a diversified portfolio. Now, if you take a look at Ben and Jerry, it's also a stock listed. But maybe Ben & Jerry has, compared to Unilever, a higher cost of capital. That may be the case. We don't know, but may be the case. So in theory, we would argue that if Unilever has a low cost of capital, and can attract cheap funding on the market. And that's, I think, your point. They can take over Pedagogy, reduce the debt, and put in more debt if they like, and it's at a lower rate. Then that's your argument, and therefore to lower the cost of capital. That would possibly be a solution. I can tell you from this case, and we're going to work with that the cost of capital of Unilever and Pedagogy were a little bit the same. So we're going to calculate in the case with the same cost of capital. So that means that we, in terms of synergies, we're not looking in this particular case at cost of capital issues, but we're looking more at, you know, the sales and the OPEX. There we look for synergies, so not so much at the cost of capital. But it is fair to say, you know, also there is something to gain, but for this case, we're not taking that into account. We take the cost of capital as the same. Okay, nice points. What did we miss? Yes.
Can I have the mic?
Yeah. What did we miss?
Yes, sir. We want to make one strategic point that if Unilever do the takeover, then Rare would take over Ben & Jerry. And later on it merged with Haagen-Dazs. Thus Unilever would no longer have a super premium.
Yeah. But okay, but what does that mean for Unilever board? You're just saying that they, whatever the cost, they need to have it. Is that your point?
Not exactly, but maybe even if it appears a bit expensive, then we can take, because this would be a very high risk proposition for us if Rare takes over.
Ah, okay. Interesting. Good one. Yeah. And a high risk is in the fact that if you're not going to buy it,
Yes.
a competitor will buy it, and you
Yes.
have a significant position in this market where you're not in. That's it, huh?
Yes, and if they're not with Haagen-Dazs, then it would be a problem.
Yeah, okay. Okay, fair enough. Anybody else? What did we miss? Yes, lady.
My name is Sophie of Constantine.
Morning.
Yeah, maybe.
Yeah, miss, yes. Lady miss, yes.
I think seeing that the assets of the company. Whether we have it not.
Yes.
Currently working at when we were
Yes.
completely optimally can we take a point?
Yes. Okay. So you're saying is that the advances in the distribution logistics is that's one of your points, yes?
Saying that the entire production that they have a good foundation of operating. Students need to increase production also.
Okay. Okay, so there's definitely synergy in the level of production, yes? Okay. Working capital that we did not write down. Okay, so we're looking for synergies also in the working capital. Okay. Yes, go ahead.
So if we can manage the interest expense.
Which one?
Interest expense.
Yeah, but we mentioned that.
Okay.
Yes. Okay, what did we miss? Maybe on this side, maybe? What did we miss? Did we mention all the ideas of creating synergies? There's also a downside, by the way. Maybe you think about what are the conditions. What I would call, we looked at this deal. We're having a discussion about if we want to look for synergies, where we need to take a look at. But what are the conditions to generate all these conditions, all these criteria? So what do we need to do in order to create synergies? What would we need to do? What would be would be the condition of actually being able to do this? Because it's not that easy, is it? So what should we have in order to enable them to do all of this? Is taking over a company is not sufficient? We simply want 100% ownership so we can do whatever we want or not? What's the downside? What are the risks? What are the alarm bells? Anybody? Yeah, so this basically spreadsheet work, yeah? But in real life, what is the downside? What's the risk? Is it possible? Yes.
Risk is that Ben Jerry from other side, like from risk point of view, I'm saying this particular point that Ben Jerry could not in last 6 years,
Yes.
could not even achieve the break even in terms of WACC.
Yes.
That is the most important thing.
Yes.
Means though they are increasing, their ROIC is increasing, return on invested capital is increasing, but at the same time they are from last 6 years they are trying to attain a break-even level as compared to their WACC, but they have not achieved that target. Right, despite of having 37% market share,
Yeah.
they could not achieve the break-even. So there is I'm looking to other competitors, the growth in terms of sales may not be as much. because of this.
Okay. So
So already they are the higher sales, higher turnover, higher turnover.
yeah, okay, I understand. So the risk is more or less in the if you can actually increase the market share,
Yeah.
you know,
So
and
market share increase, the growth, the possibility of increasing the market
Yes,
share
yes.
would be somewhat less. Because
Yes.
already they were
so maybe you could be too optimistic.
Yeah.
Maybe there's not that much growth than we expected.
or the export sales.
Yes.
But looking to the shelf life of ice cream,
Yeah.
exports can be a difficult.
Okay. Yes, please.
They have a better idea of investment.
Okay. But how can, if we talk about, if the market share on its own is very difficult to, to expand, what can you do that? What's your idea?
You do all the participants on the
Yes, you need to.
online part.
So the question is, okay, you're talking about market share, maybe manager and some cannot increase the market share enough, but what would we Unilever be able to do about that?
Also, by creating strategies with key persons of the entity like statement of
Yeah, okay. Okay, fair enough. The question was like talking about the downsides. So the downside is that even though we expect the market to increase, maybe the combination of Unilever manager will not be able to generate that. And that's one of the downsides. We don't know. Maybe we're too optimistic about it.
Yeah.
Yes? Okay, somebody else? Yes, go ahead. So go back to the question downside with the risk. So what is,
only downside, what we can say is that in 93, their net sales were 140.
yes,
And their net income was 7.65.
yes,
In 1999, their net sales were almost double, approximately 237.
yes,
But their net income is down, like it is less than the net income of 1993. So they have increased their sales and everything. Yes, their net final, which is it is actually decreasing.
yes.
So that would be a big signal for me that
Okay.
it is risky.
Yes, but my counter argument would be, yeah, I see this, but if I were Unilever, I can change it around.
Yeah, that by reducing the expensive thing.
Yes,
And the second one, what we can see that in this their balance sheet, if they can manage their this accounts payable and expenses.
yes,
Because it's a one-time expenses or
Yes.
manage it by months.
Right.
It can also increase by 3 times.
Yeah, well,
if you
yeah.
manage the current liability, especially accounts payable and accrued expenses.
yeah, that's the working capital management. Yes. But in particularly, I'm looking for also downside risks. What are the alarm bells ringing? And if you look at this transaction, I have two hands. So in the back, you also yes. The work.
So the calculation says that the return on invested capital is less than the WACC. That's the most important negative point for the Unilever to acquire. Because ROC is basically 8.8% and WACC is 10%. So the spread is negative 1.2%.
Yes,
And net revenue also continuously declines.
okay, yes, fair enough. And then in the back, there's one more, then we move on.
As we discussed the point, that the corporates, otherwise other corporates would, take on the advantage. But, the downside of that particular point is, if we go for an extended further that, then we like desperate to, have to control to be oversized that, and it is a Actually,
So,
downside of it.
Okay.
Important even to buy in expensive manner and compete with the point, but it has.
yeah, okay. Yeah, go ahead, last, yes.
Fine. And they're working capital is also good management. So it is just we to increase it. It has to be already. Yeah. So it is
Yes.
just working because we want to get into this.
Yes.
I feel this.
Last question, what would be the downside of this whole deal? What would be a risk if you report unilever? Okay, there is of course risk.
I don't feel that it's clear is because it is only that they have a lot of training. Increasing your height.
Yes, okay. So it's a good, okay, fair enough, okay, so this deal is then a win-win, that's what you're saying, guys. Yes, okay, now let's move on to the pricing, because if this is a win-win as we've argued, we've discussed, a lot of synergies and, cost of goods sold, there's synergies, we've just been said it a couple of times. We could have synergies in the logistics, in the working capital, especially market share. There's another argument why we should buy it, because there's the competitors in the market. We don't want to have competitors getting the Ben and Jerry, so there are all kinds of reasons to move on, and we're getting into touch with Ben and Jerry to actually acquire it. What we're going to do now for 90 minutes, we have 90 minutes for that. We're going to work on a case, and this is how the case goes, and I would like to open it. And again, by table. Yes. Okay, I'll just continue. Okay, so what's the story? Ben and Jerry at the end of 1999 were having problems with investors. Obviously, the problems with investors are related to what we discussed yesterday. They think economic profit is simply negative. It does, in the last years, it's going up, so it becomes less negative, so that's good. But still, on the 6 year time window, the stock price did not really move from its place. So investors were very, very happy with that. And they actually have forced Ben and Jerry, the owners of the company, to sell the organization in the market. Now, if you can read it in the case, there are a couple of competitors who are actually interested in buying it. The major competitors that were interested in buying it was called Dryer. Yeah. But there's a problem with Dryer, because Dryer is using his own trucks. Dryer is a big machine company. Basically, what they do, they have a whole distribution network in the United States. Ben and Jerry doesn't have its own distribution network in the United States. They make use of Dryer. That's also why the SG&A is so expensive. Yes. Dryer simply say, I have a truck. I also looked at the Ben and Jerry ice cream. We need to go to sell ice cream to the retailers in the USA. Dryer is simply saying, well, we want your organization, we would like to buy your organization. But the negotiations were a little bit tough. And Dryer at the end of the day said, if you don't sell to us, we're simply going to kick you out of our distribution network. And so they more or less forced Ben and Jerry to sell the company to them. And Ben and Jerry, as independent as they are, they didn't like that. And they said, well, you know what, we're going to look for another buyer. It was the name of Unilever.
But Unilever didn't have any intention in the first place to buy the interest. So then they become a name on the table, and that's where we come in. And the question is, okay, if you would be Unilever, board, how would you how would you pay for this particular company? Remember, it's all positive. I understand. The financials have to all look negative. So it's a dilemma. We see synergies, but currently on its own, it's all quite negative profitability. So there's like, how do we combine that into a valuation? Should we pay a higher amount for a company that makes a loss? Do we pay like a lower amount, which is more realistic, compared to the potential that we've seen in the past? This is the stock price. Oh yeah, by the way, this is important. There are 8,375,000 shares. 8,375,000 shares. Yes, it's important. So you need to write that down. Okay. Stock price. Okay, so 90 minutes case. The idea is to make actually the idea was to make a PowerPoint, but I'm not sure if every table has a computer. I think so, or not? I think so. Okay, so it's a we could also use a piece of paper, but the PowerPoint is nice. But I think we should work on PowerPoint, which we normally do. The case goes like this: you are the CFO of Unilever. Okay, CFO. Your board members want to pay $300 million for the company, for the shares. 300 million. Yeah, it's in there, right? 300 million. That is about $36 per share. The share is currently trading at about, I would say, 28. So the premium that you can pay for the company is very high. Yes? You're the CFO, so you're looking at this, your board members, and they want to pay $300 million. You're like, okay, I'm not so sure about the price. Maybe it's too expensive, maybe it's the right price, we don't know. You go to have a meeting with your board members, and you would like to make a pitch about the deal. And the pitch about the deal for your board members exists out of 5 pages. The first page is telling your other board members who are non-financials, you need to tell them about the financial performance of the company, Pedagogy. Yes, this is slide 1. Since it's a 90 minutes compressed time, don't spend too much time on slide 1, because it's all this what we've already done yesterday. Same thing. So if you want to be quick about it, go to your slide on the wall. Just take out a few good points and be done with it. Yes. So don't spend too much time on slide 1. We already did that. Okay. So slide number 2. If $300 million needs to be paid for the equity, that's what your board members want to. What is then, given the 10% cost of capital of Unilever, what is then the cash flow to capital that you need to generate to satisfy 10% on the capital? Yes. So again, question 2A, it's all in the case. The question 2A is, okay, $300 million is going to be put in by equity by Unilever. That's going to be debt in it. So the total exposure is going to be about 370 million. If you want to pay 10% on that, how much cash flow needs the business to generate? Yes, to satisfy the 10% on the capital. That's how it goes. Yes. Question B, is there a cash flow gap? Obviously, there is a huge cash flow gap. You need to close it. Of course, that's they're on the board. That's discussion we have. To close the gap. Well, in a market share, production, you can think about it. Don't over-analyze it. Just write down a few bullet points. Yes. Then we go to slide 3. Here, the investment bank, this is, by the way, a real case. I didn't make anything up or something. It's a real case. So, in our case, which is the Dutch investment bank, and they help the board of Unilever to come with an evaluation. They're going to tell you this. The expected top line growth in the 5-year forecast is going to be 10% per year. Okay, it's a given. They've done some market research. They're thinking, well, you know what? In terms of the top line, we expect the combination Unilever Pedagogy to increase the sales by 10% per year. So 10% in 2000, 10% in 2001, so 3%. 30, 40, that's how you continue. 10% per year, yeah, building up, okay? What you need to do in your 5-year forecast, what do you think is a realistic assumption concerning cost of goods sold and SG&A? That's where you come in. Of course, I know the real numbers, but I want you to figure out by table, what do you think, to what extent can we push down the SG&A to a realistic level? Yes? CAPEX is given. So CAPEX, capital expenditures, working capital, including fixed assets, is given also 5 million per year. So putting your model 5 million per year. So one step back, you need to come up with a spreadsheet model. I already sent you the spreadsheet yesterday, which is called 3A. You can basically extend the cash flow for 5 years and build your own forecast model. Right? Yeah, that's what you need to do. Sales increase, you go to CAPEX in. The only thing that you can change is the SG&A in the cost of goods sold. Okay, that's where you need to think about how can we downside. Then the question is, you generate a cash flow. Yeah. And is this cash flow sufficient? Is there still a gap? Yeah. And then the question is, it's all in the text. Based on your forecasted cash flows, what is going to be the price? Yes. So you have the first slide was the second slide was about 300 million. It was the scenario of your other members. But now in this slide, you have your own valuation. Maybe some of you will come up with 600 million. Maybe some of you will come with 100 million. There's going to be a wide range of valuations. Yes. And but bottom line, always need to ask yourself is whatever I put in the model, is it realistic? Can it be done? Yes or no? Yeah, can it be done? Like it's a real case. Like would I put my money on the line? Would I really, pay this amount of money for the company? Is my synergies not, overstretching it? Yeah, so this is what you need to discuss. You don't really need these data. This is just for descriptives. You don't need to spend too much time on that. Then slide 4 is the multiples. So for example, but make it nice, that's like a bar here. You have the multiples of your peers. For example, your trade is 47.2 net earnings, PE. Now, you also have 2 scenarios for your own. You have the 300 million that you can put in. That's a multiple. And you can put in any of your own valuations. Put that one in a multiple. So in other words, you have a very nice graph. It shows you the multiples of peers, including the comparable multiple of your own valuation and then of the 300 million that the board members pay. Yeah. The question is, okay, what are we going to do? This is go or no go. Yes. And by table, I'm going to write down a few things. I'm going to write down the EBIT margin, because that's what is really relevant. Every table has an EBIT margin. I would like to know what's the EBIT margin in year 5. Yes? What's your EBIT margin in year 5? Yes. Second question, what is the cash flow in year 5? Yes. And the third question is, what's the total stock that you're going to that you think is bigger? Okay. That's it. So I'm going to slide these are from the margin, cash flow in your and ultimately okay, what do you think fair price? Okay. What we're going to do after you finish the presentation, I'm going to basically select a couple of groups who are going to be standing up here to present a pitch. Yeah? That's the idea. Yes? Okay. We have 90 minutes for that. It's pretty much time compressing. It's a really fun thing to do. Incorporates everything. Yeah, we should be up to 90 minutes. Okay? Then we're going to have a good few presentations. Okay? I'll be walking around all week. Yeah, we have great. But maybe we have 1 hour left. So we work up to 1 o'clock, that's a break. And we can talk about it. And after the break, we will continue for half an hour. Yes, that's how it goes. Spend too much time on slide one, 40 again yesterday. Spend more time on slide 2, 3, and 4. It should be impacted. So that yeah, slide one. This is a multiplication. Or something. It's only already there for the market or बारह महीने पूरा चलेगा चार महीने से कंप्लीट कर लेकिन उसके बावजूद उनका हायर ये नीचे बोर्ड का नीचे टीवी तो नीचे
करके बोलो कुछ चीज है राइट की अभी पूरा बात चला 10% से पहले खेल में उड़ा 10% खत्म पड़ेगा यहां पे 10% तो ये वाले का ये वाला 10% इसकी सेल 10% इसके सेल रेशो में वो बढ़ रहा है रेशो के अंदर फिगर लेना पहले आगे करना What it? Delete कर दो और delete good. Let's take it. Because online participants को भी दिक्कत हो रही है they know they have to एक बार माइक दे दो एक माइक दे दो Delegate company दे रहे हैं
Participants, if you have any queries, so you can just post it in the chat box. Thank you.
भाई आगे भी पढ़ नहीं पा रहा
Depreciation, but cash flow doesn't matter either. So, the depreciation still remains, I appreciate it. Everybody was out to say it. The group. But the institute, if we'll never put together.
Projection using one value. Then for online participant, what you have to do, there is a case, there is a PPT that is being forwarded to you on our WhatsApp group. The name of the PPT is case BJ3P PPTX. Case BJ3P PPTX. Now, you have to go through your case study. There are 5 slides you have to prepare, and there is a Excel spreadsheet case BJ3A. In that, you have Excel spreadsheet, and the data from 1993 to 1999 is there. So you have to extend the Excel sheet for 5 years. You have to extend the Excel sheet for 5 years. Assuming that there is 10% growth in sales, then you have to in a realistic manner. Accordingly, you have to decide that the sales would increase by 10% and other expenditures may increase, may decrease. So you need to take a realistic approach to it. Fine. This is the first step you have to do. So accordingly, please go through the slides and see what type of preparation you have to do. I hope it is clear for all participants also. Anyone can just write in the box if it is clear. If it is not clear, please write it. Okay. Yeah. Okay, something there is some instruction from our resource person. Please, sir.
Depreciation stays the same, depreciation is 7,900. So you don't change that. Depreciation stays the same, 7,900.
Suppose everything you have to think fixed assets are not increasing, the depreciation value you have to keep at fixed level. Assuming that you are charging on instant time assets. Enter income of business. Yeah. So all of other features you are living sales. So when you are living sales, the cost of goods will use I agree. Because Afghan is very For online participants, I will get it loud and clear. All the online participants, please, wherever you are sitting, please take the best advantage of the case study. And if you are facing any difficulty, please write it on your chat box so that we can answer your query. Free only. Because you cannot reduce the cost more than the level that is required. It is only marginal increase.
Yes. So we will.
Capital structure and the equity cost. To be
This will get us always compared to the next one, 79. That cash flow is the first cash flow. So it's always compared to the rest of the flow. Yes. Always.
ये ऐसा भी कर सकते हैं धीरे धीरे वो वो भी बच्चे पढ़ने से 4 दिन खाएंगे बच्चे पढ़ते थे करो दान में करते लास्ट ईयर cash flow, the reference that you will take from the last year. Cash flow 1999 you have to consider. नहीं 25% income 24% ना जितना है उसका 25% के बाद तो 25% इंटरेस्ट कम लगता है और इंटरेस्ट कॉस्ट है 25% कम लगता है तो इंटरेस्ट year अपन मार्केट लगाया ये फर्स्ट ईयर है ठीक है लेकिन आप एक बोले लेकिन इंटरेस्ट कम कर डेट कम कर दो लेकिन जो ये है ये देव रहे जो उन्होंने पोस्टिंग प्राप्त होगी ना आपका उन्होंने क्या करा एक तो बड़ा ही लेकिन उन्होंने तो बहुत ज्यादा बढ़ा दिया खर्चा अपन प्रोफेशन में खर्चे नहीं बढ़ाए ना एवरेज आपका तो खेल पड़ता है हाँ ये तो क्यों नहीं किया क्योंकि अपने आ रहे ना अपनी गेम आई तो उसकी क्लोज उसके अंदर आके देखो कर ले चलो कहा तक कुछ
अपन एक्सीडेंट कराने दिए ये फिगर हाँ फिर तो ये फिगर सेम ले रहे हैं
12% नेट प्रॉफिट है नहीं है 12% लिया है ठीक है ना कैपिटल मत बढ़ाओ नहीं in a spreadsheet, you think that that's the case. Is and then the depreciation stay, and the pay threshold is per year. वो सेम होगा वो बनाने नहीं अच्छा नहीं मैं भी
Like, if you have any doubt, if you have any queries, you might be able to fix it. We'll be happy to resolve your queries. Happy to open. I again, participants who are connected online, if you have any queries, if you have any doubt, so you can post your doubt queries in the chat box. Thank you so much.
पूरा फेल बटन चलूं के पॉइंट बच्चे लगाने सिंपल डिवाइड करो हां डिवाइड करो प्रॉफिट हां उसको मल्टीप्लाई करते हैं तो getting this again आपको करने की जरूरत नहीं मैं आपको कब तक बोल रहा हूँ ये बोला था ये मैंने दे रखा है इस पे उनको उठा के यही यही तो यही बोला कि मेरे इसमें डाल नहीं वो तो जब यहाँ नहीं है ये रहा ऊपर वाला तो बना हुआ है तो बना हुआ है ये तो कुछ मुझे 4 में 8 के सबसे बड़ा वो बन गया क्या रखने को जाएगा निकलेगा ना करने के बाद दोनों का लगे can be calculated using the sheet that we have forwarded to you. Okay, we have forwarded one sheet to which we have calculated yesterday. Right, we so you have to just put the values and every value that you have calculated of 1999 and 2004. And the difference would be calculated. Okay, just use that particular format. Increase या decrease working capital cost of capital. So 6810. क्या हो गया यार, ध्यान ही नहीं देना है, इन्वेस्टेड कैपिटल पे ध्यान ही नहीं देना है. Only we have to focus on the income statement and then you have to convert a profit to result of the corporate बना के
मार्केट में भी आप कंपनी में
So we will arrange it for you.
क्या नाम है वो? So there is one from all the participants. There is one question from all the participants that it's yeah, that's right. The question is that how to identify the P multiple. Right, we have taken 25 in previous question yesterday.
Yes.
So here what should be the P multiple?
Yes. Okay.
What is the answer for that?
So the peer multiples are given.
Four peer group multiples are
Yes.
given.
The only multiples that you need to add is the 300 million divided by net earnings.
Okay.
That's one multiple, scenario one, and then multiple scenario two, which is your road valuation, whatever it is, divided by the net earnings of 1999.
Right.
Yes.
Two P multiples. I hope you have got the how to calculate P multiple.
99.
LPA upon EPA practical. Having upon total amount. P multiple 1999 will be saved for all the companies. P multiple for 2012. अच्छी बात नहीं आपको कुछ भी लिए में तो तब वो हटा के क्या
हटा के
ये गलत तो दोनों फॉर्मूला लगा देंगे Account Rakesh ji and Tony. Yeah, luckily. Price upon a ring, price for the on the current नहीं ये पूरी ये तो इनको क्या ये कॉन्सेप्ट का रखा है इन्होंने ये काम तो के पारी हां नहीं है ये फाइनेंस करते हैं मल्टीपल मार्केट में मल्टीपल यानी अर्निंग eight of minus the market value, 10% of market value, ये 10% of market value, और ये क्या हो गया? अभी का करंट मार्केट अभी कौन सा करंट कैलकुलेट करते हैं? हाँ तो बस इसके हिसाब से कहते हैं इसमें को क्या नहीं निकालना है जैसे क्योंकि बस ये वाला नहीं एमपी और ये क्या
It's time for lunch, but before we go to lunch, we have 30 minutes left to finish the case. But before we go to finish the case, just a quick Q&A. Some of you still have some questions, maybe we can learn from that. Anybody, what's the question you have? Anybody have anything? Nobody? Maybe I have some points. I have some points. First of all, let me go. Let me go to slide 1. It works. Okay, well, but anyways, slide number 1, that's the starting point for the case. The objective of the case is all the way back. What are we doing? We're doing here we are board of believer, and we need to convince our this. Things. We go into the test now. 70 check. Is it fair? Should we pay more? Should we pay lower? The first slide is on what we did yesterday. Is there any question on that slide? Because you don't spend too much time on it. Yes? Negative economic profit, stock price declining, that's a little bit it. Growing is lower than the cost of capital. To highlight bullet points, that's it. Slide 1. Yes? Okay. Slide 2. Slide 2. Okay. Slide 2 is about the following. The cash flow gap, of course, is there. Because if you want to pay 300 million, including the debt, which is about 316 million, right? And you need to pay 10% of that. You need, what cash flow do you need? About 32 million. Everybody should have about 32 million. That's correct. You have this, right? Yeah. So 32 million is what you need to have in order to satisfy, the capital exposure that Unilever needs to bring. Because Unilever is going basically has an exposure of capital of about 317 million. 300 million. What's that? About 17 million. So the exposure Unilever puts in Pedagogy is 370 million of their own money, doing that, and then you pay 10% on it. So the cash flow achieved without Pedagogy is about 22 million. Now, so this is what you need to get out of it. The cash flow last year, which is the reference cash flow, is about 17 million. So the gap is about, I think, 17 million, correct? Okay, fair enough. Slide 2, slide 3. This is a little bit more tricky. Here you go to value your own cash flow. The starting point is to go to in your spreadsheet to go to step 3. I think it's called step 3, right? Cash flow. Yes. So in your spreadsheet model, it's called step 3, which is the cash flow. Or step 2? No, step 2, right? Step 2, yes. Then you need to extrapolate Your cash flow for 5 years. Yes. Top line goes up with 10% per year. Yes. Depreciation stays the same, 7,900 every year. And then your CapEx is 5 million per year. Yes. The only things that you can change is your cost of goods sold and your SG&A. Yes. Okay, well then you're almost done. And then step 4. Sorry. Okay. Two valuations. You have the 300 million equity of your board members, and you have your own valuation. I'm not sure what it is. Let's assume it's like 400 million. I'm just saying something. Then the 300 million and 400 million should be divided by the net earnings of 1999. Yes. And then you have two multiples. And then you make a bar graph. And you put your two scenarios in it, so you can convince the board, okay, this is the PE multiple, this scenario, compared to the peer group. Yeah, it follows. And then slide 5 will be, okay, given that we all done this calculation with our own work, what do you think we should do? Is the assumption that we made is realistic or not? Then that's it, yeah. But I think most of you have actually done some pretty good work, and we're going to continue after the break, yes? Yes. We can break for 1 hour. Okay? Okay.
Online participants, we are going to take a break of 1 hour. So we will be starting soon at 2 p.m. sharp. So you can take your break as well. Thank you so much.